Everyone's talking about gold, right? It's all over the headlines, smashing records and grabbing investors' attention as it flirts with highs near $3,800 an ounce. But here's the thing, while all eyes have been on gold's fantastic run, they're looking in the wrong place. There's another bull market happening in precious metals, a secret one, and it's not the one you think. While gold has been stealing the show, silver has been quietly staging a massive, breathtaking rally. As of right now, silver has surged over 40% this year alone, hitting highs around $44 an ounce, a level we haven't seen in over a decade. And trust me, this isn't just a momentary spike. It's a fundamental repricing driven by a huge growing supply deficit that most people don't even see coming. In the next few minutes, I'm going to break down the 5 key reasons why this is happening, why silver is secretly lapping gold, and how it's creating a rare opportunity. We'll get into the investment strategies designed to tap into this unique market imbalance. This isn't just speculation, it's about fundamental shifts in the global economy that are creating an incredible setup for silver. I am Turbo, and this is Turbo Stacking, where we stack with purpose. Let's roll. The heart of this story, the secret the market is just starting to wake up to, is a severe and structural deficit in the silver market. For the last several years, the world has simply been consuming far more silver than it produces. We're talking about a massive supply hole that just keeps getting bigger. Unlike past cycles, this isn't a temporary squeeze. This is a structural change. Industrial demand now makes up nearly 60% of all silver consumption, a big jump from about 50% just a decade ago. This means silver isn't just a monetary metal like gold anymore. It has become an absolutely essential commodity, critical to the tech that powers our entire 21st century economy. And that brings us to the first and maybe the most powerful reason for silver's secret surge. The first pillar holding up silver's incredible performance is an industrial demand supercycle, and it's being led by the global green energy transition. Silver is the most electrically conductive metal on the planet, which makes it irreplaceable in a ton of modern tech. 2 sectors in particular are eating up silver at unprecedented and frankly unsustainable rates: solar energy and electric vehicles. Let's talk solar. Every single crystalline silicon panel uses silver paste to work. The solar industry consumed a staggering 197.6 million ounces in 2024, which was almost 20% of the entire global silver demand. To give you some perspective, that share was only 5% 10 years prior in 2014. Now, manufacturers are trying to use less silver per panel, a process called thrifting, but the sheer volume of new solar farms going up is completely overwhelming those savings. Projections show silver demand from the solar sector is on a track to keep growing by 8 to 10% a year through 2030. Then you have the explosion in electric vehicles. Your average EV needs between 25 and 50 grams of silver, way more than the 15 to 28 grams in a gas-powered car. As the world switches to EVs and cars get loaded with more tech, the amount of silver in each vehicle is only going up. Your eco-friendly ride is a silver-hungry machine. And it doesn't stop there. 5G networks, artificial intelligence, and all our consumer electronics from phones to tablets all need silver. This demand is relentless, and crucially, it's what economists call price inelastic. Industries need silver to make their products. Whether the price is $30, $40, or even $50 an ounce, they'll pay what they have to, creating a powerful and permanent source of demand that gold just doesn't have. Industrial demand is on track for another record year, pushing well past 600 million ounces in 2025. This industrial hunger is creating a fierce fight for a shrinking supply of the metal. While industrial demand is exploding, the supply side of the story is completely different and a little worrying. This is the second key reason for silver's rally: a stagnant and in some cases shrinking global supply. Here's one of the most misunderstood facts about silver. It's not usually mined on its own. Roughly 70% of all silver is just a byproduct of mining other metals like copper, lead, and zinc. What that means is, even with silver prices at decade highs, mining companies can't just flip a switch and produce more. Their output is tied to the economics of base metals. If copper prices are weak, a miner might slow down production, and silver output falls right along with it, no matter how high the silver price goes. This creates a really inflexible supply that can't respond quickly to price signals. Global silver mine outputs for 2025 is projected to be around 835 million ounces, which is actually down more than 7% from the peak back in 2016. This long-term decline points to some serious issues like aging mines, lower quality ore, and huge delays in getting new mines approved and built. A process that can usually take 5 to 10 years, although things have changed over the past year. Now, you might be thinking, what about recycling? And while silver recycling is projected to hit its highest level in over a decade, it's just not enough to fill the gap. The projected supply deficit for 2025 is still staggering, with many analysts expecting it to land somewhere between 150 and 200 million ounces. This would be the 8th year in a row that market has come up short. This is the setup. Demand from green tech is non-negotiable and growing, while supply from mines is stuck and slow to respond. Every year, the world is drawing down the available stockpiles held in vaults like the COMEX. Those registered inventories have crashed from over 150 million ounces in 2020 to just around 35 million ounces in early 2024. That's a shocking 77% drop. This physical tightness is the engine under the hood driving silver's powerful momentum. The third crucial reason silver is set to keep outperforming is a classic metric that has been the market's oldest cheat sheet for centuries, the gold to silver ratio. This ratio just tells you how many ounces of silver it takes you to buy 1 ounce of gold. When the ratio is high, silver is historically undervalued compared to gold. When it's low, silver is relatively expensive. For most of the 20th century, this ratio bounced between 40 to 1 and 60 to 1. The average over the last few decades is closer to 65 or 70 to 1. So where are we today? On September 22nd, 2025, with gold near $3,800 and silver around $44, the ratio is about 85 to 1. That is a major deviation from the historical norm. To put it simply, the current ratio is a flashing sign that silver is deeply undervalued compared to its big brother gold. History shows that during precious metals bull markets, this ratio tends to fall hard as silver's percentage gains leave gold's in the dust. We saw it happen after the ratio spiked to a wild 125 to 1 during the 2020 market panic. In the months that followed, it compressed rapidly as silver's price roared back. Today's ratio around 85 to 1 suggests we're still in the early to middle innings of this compression cycle. If that ratio were to return to its more modern average of 67 to 1, with gold holding steady at a forecasted $3,800 an ounce, it would imply a silver price of about $56 to $57 an ounce. That's a potential 52% jump from where we are now, just based upon this one metric. Seasoned investors see this high ratio not as a sign of silver's weakness, but as a coiled spring. They know that extreme moves away from the average rarely last. Reversion to the mean is one of the most powerful forces in finance, and right now it's pointing a giant arrow directly at silver. For years, silver's identity has been all about its industrial uses, but the fourth reason for its recent surge is that its ancient role as a monetary metal and safe haven asset is waking up, and this time, things are different. Investors are piling into precious metals for the usual reasons: to shield their wealth from inflation, currency games, and global uncertainty. We're seeing central banks around the world buying gold at a historic clip, with forecasted purchases of 900 tons in 2025 as they try to get away from the US dollar. This rush into tangible assets is a huge tailwind for all precious metals. But here's the kicker. When investors turn to silver this time, they're walking into a fundamentally changed market. In the past, investment demand could be soaked up pretty easily. Today, those investors are competing head-to-head with industrial giants like Tesla, Apple, and the world's biggest solar companies for a shrinking pool of available silver. This creates a dramatic pincer movement on the silver supply. On one side, you have relentless industrial demand that has to be filled. On the other, you have a growing wave of investment demand from people looking for a hedge. This dynamic just doesn't exist for gold, where industrial demand is only about 10% of the market. We're already seeing the results. There have been huge inflows into silver-backed ETPs, which are investment products that store physical silver in vaults. This effectively takes millions of ounces of metal off the market, making it unavailable for industrial use and squeezing the physical market even tighter. This tug-of-war between factory floors and investors for a limited supply is a recipe for explosive price action. As more people wake up to the supply deficit story, this monetary demand is likely to accelerate, pouring gasoline on an already burning fire. The fifth and final reason silver has the potential to keep outrunning gold comes down to market psychology and simple access. Silver has always been called the people's money or poor man's gold, and this trait becomes a powerful rocket booster during a bull market. With gold trading for thousands of dollars an ounce, it can feel out of reach for many everyday investors. Buying even 1 ounce of gold is a serious commitment. Silver, on the other hand, trading around $40 to $45 an ounce is way more accessible. An investor can build a real tangible position in physical silver for a fraction of the cost. This lower price point creates a much bigger pool of potential buyers. When momentum builds and the mainstream public finally starts to pay attention, it's silver that often sees the most dramatic flood of retail money. This can lead to much more volatile and explosive price moves compared to gold. While gold's market is dominated by central banks and giant institutions, silver's market has a powerful retail army that can drive prices up with shocking speed. Think of it this way. Gold is the steady, powerful aircraft carrier. It's slow to turn. Silver is the nimble jet fighter capable of breathtaking acceleration. This underdog psychology means that as the story of silver's supply deficit gets out, the rush of new investors is likely to have a much bigger impact, percentage-wise, than a similar rush into the massive gold market. We're seeing the early signs now, but if the price breaks through major psychological levels like the old 2011 high, the fear of missing out, or FOMO, could truly ignite and send silver to unbelievable new heights. Now, making sense of these market shifts can be tricky. If you want to stay ahead of the curve with deep dive analysis just like this, I'd encourage you to subscribe to the channel. It's where we share our latest research on precious metals before anyone else. The link is right there in the description. So let's talk about the playbook, how you can actually position yourself for this. Understanding why silver is rising is half the battle. Knowing how to strategically invest is the other. Let me be clear, this isn't financial advice. It's an educational breakdown of the main ways investors get exposure to silver, each with its own pros and cons. Number 1, physical bullion, coins and bars. This is the most direct way to own silver, period. Holding physical bars and coins gives you the ultimate security. If you hold it, you own it. There's no middleman, no company that can go bust, and no digital account that can be frozen. This is what true wealth protection looks like for many investors. But it comes with a few things to consider. You'll pay a premium over the spot price of silver, which covers minting and dealer costs. You also need to think about secure storage, whether that's a serious safe at home or a professional depository service. And insurance is a must. Despite these costs, for anyone who puts security and direct ownership first, physical bullion is the silver standard. Number 2, silver-backed ETFs and ETPs. For those who value convenience and liquidity, exchange-traded funds are a super popular choice. Products like the iShares Silver Trusts, SLV, are designed to track the price of silver. You can buy and sell shares of an ETF just like a stock right from your brokerage account. It's an incredibly easy way to get exposure to silver's price movements without having to store any metal yourself. The main advantage is liquidity. You can get in and out of your position with a click. The downside is counterparty risk. While these funds are backed by physical silver in giant vaults, you don't actually own the metal. You own shares in a trust that owns the metal. You also pay a small annual management fee. For many, the ease of use is a worthwhile trade-off for these risks. Number 3, silver mining stocks. If you have a higher risk tolerance and you're looking for some serious leverage to the silver price, mining stocks can offer explosive potential. When the price of silver goes up, a well-run miner's profits can go up way faster. It's all about their fixed operating costs. For example, if it costs a miner $20 to produce an ounce of silver and the price moves from $30 to $40, their profit margin on each ounce just doubled from $10 to $20. And that kind of leverage can lead to stock gains that dwarf the gains in the metal itself. However, that leverage is a two-way street. Mining stocks come with a whole list of risks that physical silver doesn't have. You have operational risks like mine collapses, political risks in the countries they operate in, management mistakes, and of course the risk of the silver price falling, which can crush their profits. Within the space, you can also check out royalty and streaming companies. They don't run the mines. Instead, they give miners cash up front in exchange for the right to buy their future silver production at a super low fixed price. This business model avoids a lot of the direct mining risks while still offering fantastic leverage to the silver price. Your choice here should match your goals. Looking for long-term wealth preservation? Physical bullion is probably your focus. Looking for a liquid short-term trade? An ETF might be the ticket. Aiming for speculative gains with higher risk? Miners could be the way to go. A smart portfolio might even use a mix of all three. Since I watch the markets closely daily, I have elected to follow the aforementioned advice with the exception of the ETFs. ETFs have multiple issues, including, but not limited to, being forced to own non-performing mining equities. That's my biggest complaint, other than never seeing the 10-bagger. I prefer indexes over ETFs and physical over equities. I would never, ever touch the futures market, period. While gold has been getting the headlines it deserves, the real story of outperformance in 2025 has been quietly unfolding in the silver market. This isn't just some random frenzy. It's built on a foundation of 5 powerful, connected factors. A historic industrial demand supercycle driven by green tech that is eating up silver faster than ever. A shrinking and inflexible global supply that can't keep up. The gold to silver ratio, which is practically screaming that silver is historically cheap compared to gold. The reawakening of silver as a monetary asset, forcing investors to compete with industry for a limited supply. And the psychology of the underdog, where silver's low price point makes it perfect target for a flood of retail investors. The combination of soaring industrial demand, a constricted supply, historical undervaluation, and returning investor interest has created an incredible setup for silver. While gold will always be a cornerstone of a solid portfolio, 2025 is shaping up to be a year that silver's secret finally gets out, and its true value is put on display for the world to see. Now that you have a base understanding of why many people are talking about silver as opposed to gold, you need a buying strategy. Let's figure out your physical bullion acquiring strategy. Click this link to build your physical bullion buying strategy. Thanks for watching. God bless. As you were, stack with purpose, turbo out.